I think the stock market is sending an important signal to investors, and we're going to look at it through the lens of Chipotle's earnings, Tesla's earnings, as well as the latest developments from OpenDoor, because that has recently become a very volatile stock. So we'll be talking about all three in this video. My name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. Looking at Chipotle, I mean, this is a company that used to be a investor favorite because they're putting up monster growth figures. Well, what are they doing now? Only 3% growth in the second quarter. Their comp store sales, so no benefit from opening new stores, actually declined by 4% year over year. So that means all of their revenue growth came from opening new stores. Their existing stores shrunk a little bit. Their margins came under pressure, down about 1 to 2%. Their earnings also came under pressure, and management is saying, yeah, we think our comps, so no benefit from new stores, is going to be flat this year. That reflects that either the consumer is in trouble or there's some sort of disconnect between Chipotle's value proposition, where, the $20 burrito is not resonating with consumers right now. Maybe that's concern about tariffs, not having enough money to buy it. Not surprising to see Chipotle stock getting hit around 14% today, and looking out over the past year, down about the same amount. It's been sort of treading water because this was a favorite growth stock for a lot of folks. And then the question is, well, what do you think a business like this that's reporting, declining comps, declining margins, declining earnings, lackluster total revenue growth of only 3%, what do you think that is worth? And that's sort of the theme of this video, because I think when you look at the reality, and then you look at what's being priced in, you might go, there's some sort of disconnect here. And so let's look at this, for example. What do you think? Pause for a minute. Say to yourself, if you, ignoring Chipotle for a second, like if you had a business that was reporting those sorts of figures, declining margins, flat revenue, declining comps, declining earnings, what sort of multiple of earnings would you apply to it? Even assuming that, let's say, the growth story could double in the years ahead. What sort of multiple would you apply? Think about it. Before, if you know nothing about Chipotle, think about that for a second. And because when you look at what's going on, AI, my AI assistant Flash, it's free to use, see the link below. It's sort of saying, yeah, in a base case, maybe there's 50% upside. And it's calling out how, yeah, there's, you could effectively grow the store count to around 7,000 stores. That's what they've talked about. Maybe you get back to comp store sales growth. Maybe margins stay flat around 20%, so get a little bit of improvement. And so then, yeah, maybe you can go from, let's say, earnings this year of $1.25. So once again, that suggests around 35, 40 times earnings. So this is a very, I'd argue, expensive valuation given the growth that you're looking at. So it's saying maybe you can go from $1.25 in earnings estimates for this year. You can get some sort of, let's say, low teens growth over time. That's a combination of opening new stores, back to comp store sales, and flat margins. And so then maybe you get to $2.20 in earnings. And then if you assume, let's say, that multiples don't contract too much, that's a big assumption in my mind. But if you assume multiples stay around 32 times, then you're talking about a stock around $70. So relative to the 45, that's how you're getting this 50% plus upside. Personally, I think that's a little too aggressive for my own taste. I'd like to hear how AI thinks about it, but it's not for me. When I think about that, I would rather find something that's closer to 20 times or under, for that sort of profile. I mean, when you're saying a business is struggling because of either the current environment, even if there's a good growth potential, I mean, I'm looking at that and that just doesn't strike me as compelling enough. When you're saying, hey, this is mid 30s, in terms of an earnings multiple, why couldn't that go to 20 times? Or just go to a market multiple of closer to 25 times. Let's look at Tesla. Tesla reported I don't think there's any better way to put it than just like monstrously ugly quarter. It's just heinous looking at these numbers, to be honest. I mean, 16% decline year over year in auto, 7% decline in energy generation and storage revenue. I mean, everyone talks about, oh, that energy, look how powerful that's going to be, how fast their growth is. I mean, it's declining. You look at their profit margins, you look at their profitability, declining. Margins, declining. Adjusted EBITDA, declining. Free cash flow collapsing, down about 90%. I mean, these are heinous numbers. Looking at this, not surprising to see Tesla stock lose around just shy of 10% of its value today. Looking at their results, deliveries effectively flat for several quarters now. That suggests BYD, the Chinese competitor, is arguably taking share around the world. Looking at free cash flow, I already called out how it collapsed in the most recent quarter. Not a great picture. I like up and to the right. There are charts that you could find for companies where it's like, yeah, up and to the right, free cash flow, sales. That's not what you're seeing here. Net income, maybe between $1 and $2 billion a quarter. So somewhere between $4 billion, $8 billion in earnings for this business. Once again, what do you think that is worth? Company generating $4-8 billion, something like that per year. Well, the market's saying it doesn't matter what you think. That's what the market's saying. The market's saying it doesn't matter. It's around $1 trillion, even after today's drop. Still, $900 billion plus valuation. It doesn't matter what you think. I mean, that's what's going on here. And, the bulls are going to say, well, wait a second, Daniel, you're missing all these growth drivers. You're talking about Elon's commenting about how their bots are going to be the biggest product ever, and it's going to make Tesla the biggest company in the world. And you got robo-taxi, and that's going to roll out to half the US population in no time. And look at they have the most cutting edge chips. And, the world doesn't even understand how powerful their chips are going to be. Show me in the numbers how this picture of creating a cleaner, safer, more enjoyable world, which, believe me, I am all for. I love dancing robots. I think that's awesome. Sign me up for Westworld when it gets there. White hat most days. But looking at this, it's not showing up in the numbers. Like, it's just not there. Like, it's okay to wait for when you start seeing it in the numbers, because if he's right, and this is going to be a multi-trillion-dollar company worth more than NVIDIA in the future, you're going to have more than one quarter to get there. And I just think, once again, huge disconnect between what the market is saying it's worth versus what the fundamentals. That creates risks for investors. Does it happen to, for sure, will that disconnect between fundamentals and where things are priced? Will that collapse? Not necessarily. Things can stay irrational. Things can, you can keep this valuation. Maybe I'm wrong. Maybe, next quarter he starts proving out that low cost new car, a stripped down Model Y that really starts scaling up. You see a re-acceleration. Maybe the robotaxis, maybe some software that they, license. It shows up in the numbers. It's not showing up in the numbers now. Once again, it doesn't matter what you think. Thinking about Hulk Hogan and The Rock. I think that was The Rock's phrase. Looking at OpenDoor. This is one that's become meme status recently after a multi-100% run. Let's focus on the fundamentals, folks. Revenue declined during their most recent quarter, around $1.2 billion in revenue, and still generating monstrous losses. I mean, this is a company that has not been able to prove their core business model of buying homes and then trying to sell them for a small markup. That's the business model. They haven't been able to prove it, and their competitors have said, yeah, this is too hard. Now, I have mixed feelings about that, because when a competitor leaves a marketplace, that actually can be a good thing, because then it makes your life easier. Hey, if there's goes from 3 competitors to 1, great. You can become the home flipper that's profitable. But once again, show me in the numbers. It's not showing up in the numbers. That's the problem. It's, you're seeing revenue declines. You're seeing still monstrous losses. Even their outlook for the year. This is the following results. We expect the following results for the second quarter. Second quarter, they were saying around 1.5 and effectively flat EBITDA, which is mostly from stock-based compensation. Talking about margins of around 4-5%. For this type of business, what do you think that is worth? It's hard for me to suggest that this should be worth a lot. This was a company that's on the verge of delisting a few months ago, but speculators got involved, said, why not ramp it up from around $300 million market cap to around $2 billion market cap? I don't understand the valuation. Straight up. Doesn't make sense to me. If I ask Flash will agree with me. And so what are my thoughts, as you see these sort of, you might call them bubbles, you just look at these examples. Well, first of all, none of this is financial advice. This is just sort of my ruminating on these different companies and situations. Also, recently, Anil Y, he wrote, "I've immensely benefited from all your invaluable ideas and news thus far, and looking forward to more in the coming days." This follows Daniel M, who said, "Entering my 4th year of subscription to the Unrivaled community. Thank you and the whole community for all the insights really shaping my investment journey. If you're looking for compelling ideas, come check out Unrivaled Investing." So I think a few key ideas. I think the first thing that's worth reflecting on is that you will have periods in the market where everyone's they want to drink the crazy juice. And it's going to be up to you whether or not you want to say, hey, that looks enticing, or you're going to say, I'm happy doing my own thing. I'm happy trying to be rational, maybe even try to be conservative in my appraisal of businesses. Everyone else can go drink that crazy juice. That's fine. I wish them well. I hope OpenDoor works out for you. I don't see how. It really doesn't jump out to me when you have a declining revenue business, a business model that hasn't been proven, looking at most a couple percent margins. I did a video on OpenDoor like when it first came out, and I effectively called out the problems. You can go back to the original video. I said, it doesn't make sense to me. And there are significant risks to it. What if you have higher interest rates, for example? That was one of the chief concerns I even called out. So, okay, crazy juice versus try to walk your own path. And in this environment, I think walking your own path, in my mind, means, for me, sticking to my unrivaled investing checklist. And I try to keep it super simple because the reality is, when you're in that fog of war, when you're in that cloud thinking about investing, it's easy to get distracted by a lot of different things. So I just want to focus on a few basics. And if I get those right, I feel like it tilts the odds for me as an investor. That means an aligned management team, compelling valuation, obvious growth potential, limited or no blow-up risks. Those are the types of things I'm focusing on. I want win-win type of companies, so that way they don't, blow up in the future because it's a win-lose. Win-lose is inherently unsustainable. So in this environment where you might argue that there's an uptick in the crazy juice, you might say it's important to focus on compelling valuation more than usual when you're making new purchases. That's how at least I'm thinking about it. And so, for example, the companies that I'm calling out to my subscribers at Unrivaled Investing, I've called out a healthcare company on this channel that trades at a single-digit multiple of what management thinks. Okay, so that's one. Another example is a waste management company that trades at 12 times. Well, unless you think this type of waste management is going to disappear, 12 times strikes me as a steal, and you have aligned management. So that's the type of situation that I'm looking for, once again, straight up and to the right in terms of growth. Whereas looking at these stories, big disconnect between what the market is saying and what the fundamentals are saying. And when you have those types of disconnects, you can have a reset. And that's how you create these sort of, whoa, who removed the floorboards? And all of a sudden it's sort of that Wile E. Coyote moment, and it's like, and then you're dropping a bunch. That's how you have stock market collapses or sudden, plummeting sort of price action, is when those fundamentals get so disconnected, the fundamentals so disconnected from price, and then the fundamentals get worse and the price just goes down, 10%. It's still that huge disconnect. Then you can have that Wile E. Coyote sort of moment. So I'm mindful of that. And I'm also mindful, okay, for any new purchases, I think this is where a lot of people got in trouble back, in 2021, 2022, is that they saw the mania and they thought, I want some of that crazy juice too. And I think you would be better off trying to be rational in those moments. Now, it's tough though, and I think it is important to recognize that just because there are these moments, there are these instances where the market clearly goes, it doesn't matter what you think. It's important to recognize things can go from crazy to bananas. And there's real historical precedent for that happening, because you can look at the late 1920s, you can look at the dot-com bubble. Those are the clearest indications. I mean, there's a reason why I keep the Mellon biography, the former Treasury Secretary, over my shoulder somewhere over here. And the reason being is that if you have a hot enough economy and then you lower rates, which is arguably what President Trump is encouraging, try to keep the economy hot, let's lower rates, lower our interest expense, you could actually have valuations go from it doesn't matter what you think to what a dummy. And then it's like, holy smokes, why not rip higher, even if the fundamentals don't justify it? And that arguably is what makes investing so hard, is because there are those three components that drive return. And in the short term, the biggest component is valuation. And so if you have the Federal Reserve lower rates, it is possible that you get some sort of valuation boost that gets everyone go, Daniel, you're bananas for being conservative. Why not just ride the crazy train? That can happen. And so for me personally, I don't like saying, ooh, this person's doing something irrational, I want to do it too. I'm just going to follow my own journey. I'm going to follow this path of, aligned management team, valuations that make sense, obvious growth. And I don't have to buy in every situation that doesn't speak to me. So I think the time to think about this, to make your own plans for your investment journey, is before the outcome. Because if ultimately you don't have the rate cuts and let's say things ultimately deflate in the future, you don't want to be positioned in the most, bullish, bubbly companies that could get hit on the nose. I mean, just earlier today, there was the news about how margin debt, I think, reached a new high. I mean, that's another one of those red flags that investors should look for. That can reverse itself very quickly. So I hope this video talking about looking at these data points, Chipotle's earnings, Tesla's earnings, OpenDoor, thinking about, these data points has been helpful for you on your investment journey. Thanks so much for watching Unrivaled Investing.